So on April 8th, 2026, millions of barrels of crude oil suddenly started flowing through like the narrowest choke point in the Persian Gulf.
Right.
And in what seems like a completely unrelated event on that exact same day, a heavily guarded server farm in California solved a multivariable quantum physics problem faster than any human alive.
Yeah, which is just wild to think about.
Totally wild. And today, we're looking at how those two specific moments kind of collided to create one of the most explosive days in modern Wall Street history.
It really is rare to see the physical world and the digital sphere experience simultaneous seismic shifts like that.
Yeah.
But when they do, I mean, the financial markets become the ultimate seismograph.
Yeah.
We're talking about two distinct unblockings here, so one geopolitical and one technological, and they hit the trading desks at the exact same time.
And our mission on this deep dive is to sift through the data of that collision. Because there's a lot of noise out there right now.
There is so much noise.
Yeah. Right. So we're pulling from a massive stack of sources today. Some of these are paywalled, some are blocked, or just, completely buried under the sheer volume of chaotic news feeds we all deal with.
Yeah.
We've got reports from Morningstar, we've got trading key data, the Motley Fool, and the latest benchmarks from artificial analysis. We're going to extract the signal from the noise, looking at the twin engines that drove this massive market rally.
And just to set the baseline for you, the sheer velocity of the capital movement on April 8th was just staggering.
Let's give them the numbers.
Yeah, so the S&P 500 jumped 2.51% to close at 6,782.81.
Massive.
The Nasdaq rose 2.80% to 22,634.99.
Right.
And the Dow Jones Industrial Average leaped 2.85% to 47,909.92. You just do not see across the board near 3% jumps across major indices without something fundamental breaking wide open in the underlying economy.
Okay, let's unpack this. We have a very clear roadmap for you today.
Mm-hmm.
First, we are looking at the physical world, the concrete reality of oil, cargo ships, and the literal arteries of global trade.
The heavy stuff.
Exactly, the heavy stuff. Then we are going to pivot into the digital world, specifically diving into a shock AI release from Meta that completely caught Silicon Valley off guard.
But before we get into the mechanics of global shipping lanes, we really need to be incredibly clear about our lens here today.
Yes, absolutely. Because the geopolitical catalyst for this market movement involves regions and conflicts that are, well, deeply complex and highly charged.
Extremely charged.
Which is why we need to state right up front, this deep dive is strictly analyzing the market.
Just the market.
Right, the economic impacts and the financial data provided in our source material. We are taking absolutely no political sides regarding the U.S.-Iran conflict.
None whatsoever.
Our focus is entirely, 100%, on how this geopolitical event interacts with the global economy, supply chains, and the stock market. We are just looking at the math and the logistics, period.
And the logistics of the Strait of Hormuz, I mean, they cannot be overstated. The Motley Fool report we have details the macro earthquake of the day, which was a 2-week U.S.-Iran ceasefire.
2 weeks, right?
Yeah, 2 weeks. And the immediate critical consequence of this agreement is the reopening of the strait for the first time in over 5 weeks.
Wow, 5 weeks.
When you sever that specific waterway, you aren't just delaying shipments, you are fundamentally altering the risk profile of global energy.
Let's look at the immediate fallout of that artery reopening because the numbers are crazy. The Motley Fool notes that WTI crude oil plunged 15% down to $96 a barrel on the news.
In a single day.
Right, in a single trading session. I want to drill down into that because a 15% drop in a highly liquid global commodity market is violent. What are the actual mechanics driving a cliff drop like that?
Well, what's fascinating here is the sheer physics of global trade intersecting with forward contract pricing.
Okay, break that down.
So when the strait is closed for 5 weeks, millions of barrels of oil per day are physically trapped.
Right, they literally can't move.
Yeah, exactly. Or they're forced into massively inefficient detours all the way around the Horn of Africa. The market isn't just pricing in the missing barrels today. Traders are pricing in a massive premium for the fear of scarcity tomorrow.
The fear premium.
Right. That risk premium is built into every single futures contract.
So traders are effectively hoarding digital paper barrels, betting the supply will remain tight indefinitely.
Exactly that. The physical bottleneck creates a financial bottleneck. But the moment the ceasefire is announced and the waterway is cleared, all that pent-up physical supply is suddenly back on the schedule.
It's just released.
It's released. So the mathematical justification for that fear-based risk premium, it just evaporates in seconds. The forward curves collapse. It is a violent, rapid repricing of reality because the artificial scarcity is gone.
You know, the old analogy was always a kink in a garden hose.
Right, yeah.
But that feels too simplistic for this scale. It's more like a massive dam holding back a reservoir.
Oh.
The pressure on the wall is immense, and the people downstream are paying a fortune for just a trickle of water. The second you open the floodgates, the water isn't scarce anymore, and the spot price just collapses.
And you can see this instant repricing reflected in the equities almost immediately.
Yeah, the Morningstar data showed that.
Right. ExxonMobil was up only 1.21%, and Chevron was up just 1.13%.
Which is lagging the broader market.
Heavily lagging. Because when the underlying asset you pull out of the ground loses 15% of its value before lunch, your stock is going to struggle to keep pace with a 3% market rally.
But the operational leverage cuts both ways, doesn't it?
Oh, absolutely. The companies burning that fuel saw a massive expansion in their forward-looking valuations.
Like the airlines.
Yes. Delta Airlines jumped 2.19%, and United Airlines climbed 1.56%.
I want to push past the obvious here, though. I mean, we know airlines burn jet fuel, and cheaper fuel means higher margins. That's basic.
Yep.
But there has to be more to a 2% equity jump than just a spot price drop in crude, especially since these major carriers heavily hedge their fuel costs months or even years in advance anyway. They aren't buying fuel at the pump today.
You're hitting on the exact operational friction that the market was pricing in. It isn't just the cost per gallon.
What is it then?
When a major conflict shuts down a global shipping lane for 5 weeks, the entire logistical ballet of global aviation and maritime shipping just falls apart.
Because they have to route around it.
Right. Airlines have to route around conflict zones. That adds flight hours. It increases crew fatigue. It triggers union overtime thresholds. And it significantly increases wear and tear on the airframes.
Ah, I didn't even think about the union overtime or the maintenance cycle.
It cascades. So the unblocking removes the operational nightmare, not just the fuel surcharge.
So it brings predictability back to their operating models.
Precisely. When analysts can accurately model an airline's expenses without factoring in wildcard geopolitical detours, the stock is assigned a higher multiple.
Okay, I see that. That makes total sense. But I'm looking at the broader indices. The S&P 500 went up 2.51%. The Dow jumped almost 3%.
Yeah.
How does a drop in the price of crude oil, even a massive 15% drop, ignite a surge across the entire breadth of the stock market? Most of the companies in the S&P 500 aren't airlines or shipping conglomerates. They are tech companies, banks, healthcare.
If we connect this to the bigger picture, the transmission mechanism between crude oil and, say, a software company's stock price is inflation.
Inflation, right?
Energy is the foundational input cost for the entire global economy. It's the cost of manufacturing the plastic casing for a server. It's the cost of diesel for the truck delivering it. It's the cost of the power grid running the data center.
Everything touches energy.
Everything. So for the last 5 weeks, the market has been pricing in a scenario where energy-driven inflation forces the Federal Reserve to hold interest rates higher for longer.
Or perhaps even hike them again, which people were starting to whisper about.
Exactly. The fear of hikes was creeping back in. And higher rates compress the valuation multiples of every single asset class.
Because money's more expensive.
Yes. But the moment oil plunges 15%, the baseline inflation models get revised downward, instantly.
Okay.
That immediately causes the bond market to reassess the probability of interest rate cuts this year. Cheaper borrowing costs increase the present value of future corporate cash flows.
So that is why the whole board lights up green. Geopolitics unlocks the oil, cheaper oil lowers inflation estimates, lower inflation revives rate cut hopes, and lower rates lift all boats.
That's the chain reaction. But the bond market is inherently skeptical. The Motley Fool report explicitly points out that Wall Street remains somewhat cautious.
Cautious why? The market jumped 3%.
Because a 2-week ceasefire is merely the beginning of negotiations. A fortnight pause is not a structural peace treaty.
Right. That is the crucial nuance. The market is celebrating the trajectory, not the final destination.
Exactly.
Yeah.
Clearing the maritime backlog, repositioning those massive, very large crude carriers, normalizing the insurance premiums for vessels entering the Gulf that takes months. It doesn't happen in 2 weeks.
Which brings me to a data point from Trading Key that I really want to pull apart here. Because in the middle of all this macro shifting, Trading Key noted that JP Morgan Chase, ticker JPM, moved up by 3.05% on April 8th.
Okay, yes.
And I'm looking at this JPM chart, and honestly, it makes zero sense to me.
Let's hear the contradiction. Why doesn't it make sense?
Well, if the market is rallying because rate cut hopes are revived, why is a bank soaring? Bank margins get squeezed when rates fall.
Right.
They make their money on the spread between what they pay depositors and what they charge for loans. A rate cut compresses that net interest margin.
It does.
So if the Fed is supposedly going to cut rates because inflation fears are easing, JPM's core profitability engine should be slowing down. What am I missing here? Why are they up over 3%?
It is a brilliant contradiction if you only look at a finance textbook. But it makes perfect sense when you look at the actual economy.
Okay, lay it on me.
You are absolutely right that in a vacuum, lower rates compress a bank's net interest margin.
Right.
But banks do not operate in a vacuum. They operate on credit quality.
Are you saying the survival of the loans matters more than the profit on the spread?
Exponentially more. Think about JPM's balance sheet right now. They have hundreds of billions of dollars tied up in commercial real estate, corporate debt, and consumer credit cards.
Huge exposure.
Massive. If oil stays artificially high and the Fed is forced to keep rates punishingly high to fight that inflation, you risk pushing the entire economy into a severe stagflationary recession.
And in a severe recession, office buildings default, businesses go bankrupt, and consumers max out and default on their credit cards.
Exactly. A massive wave of loan defaults requires the bank to take billion-dollar write-downs, which decimates their capital reserves and destroys shareholder equity. So the 3.05% jump in JP Morgan stock is the market breathing a sigh of relief that a deep, energy-driven recession might be avoided.
An economy that achieves a soft landing means businesses keep borrowing and consumers keep spending.
Yes, the sheer volume of healthy loan origination combined with avoiding catastrophic defaults vastly outweighs the headwind of a slightly tighter interest rate spread.
That reframes the entire banking rally for me. It's the market choosing the lesser of two evils.
Totally.
And honestly, this highlights why this deep dive matters to you, listening right now. You might not trade crude oil futures, and you might not hold bank stocks directly.
Right.
But whether you are checking your 401k balance or, waiting for mortgage rates to stabilize so you can finally buy a house, or just trying to predict the cost of groceries next quarter, this chain reaction dictates your reality.
Everything is connected.
The physical choke points of the world dictate the monetary policy, which directly impacts your wallet.
The physical world absolutely sets the parameters for the financial world. But as we saw on April 8th, it wasn't the only engine driving the indices.
Oh, man, no, it wasn't.
While the Dow and the S&P 500 were breathing a sigh of relief over the Middle East, the Nasdaq had a completely different, highly aggressive catalyst.
It's wild that we were seeing the exact same dynamic play out in the digital space. Just as unlocking the Strait of Hormuz suddenly dropped the cost of physical energy, Meta dropping their new AI model is fundamentally about dropping the cost of digital energy.
The Nasdaq's 2.80% surge was heavily carried by Meta Platforms, which rallied a massive 6.5%, closing at $612.42.
6.5%. For a mega-cap tech company of Meta's size, a 6.5% intraday jump adds, hundreds of billions of dollars in market capitalization.
Easily. It's an astronomical amount of value created in a few hours.
And this wasn't an earnings surprise. It wasn't an ad revenue beat. It was the debut of Muse Spark.
Muse Spark.
Yeah. We have an incredibly detailed breakdown from artificial analysis that gives us the exact specs on this release. And the numbers are completely resetting the landscape.
To understand the magnitude of Muse Spark, we have to look at the timeline and the strategic silence that preceded it.
Right, because they were quiet for a while.
Very quiet. Artificial analysis notes that Meta entirely reorganized its AI infrastructure. They are now operating under a new umbrella, which they are calling Meta Superintelligence Labs.
That name is aggressive. Meta Superintelligence Labs.
It really is.
It signals they aren't just building chatbots to argue with on Facebook anymore.
It is a statement of intent. This release marks Meta violently re-entering the frontier AI race after a surprisingly long period of quiet.
Because their last major release was Llama 4, right?
Specifically the Maverick and Scout models, and that was all the way back in April of 2025.
A full year ago.
In the current pace of AI development, a year is an eternity. It's a lifetime.
I remember when Llama 4 dropped, people thought it was impressive for an open-weight model at the time.
It was.
But let's look at the actual benchmarks. According to artificial analysis back in 2025, Llama 4 Maverick scored an 18 on the intelligence index.
18.
and 18.
Which was respectable for a non-reasoning model at that specific moment in time.
But exactly a year later, Muse Spark debuts and scores a 52 on that same intelligence index.
It's a staggering leap.
It leapfrogs almost everything. It slots into the absolute top tier, sitting behind only Gemini 3.1 Pro, GPT 5.4, and Claude Opus 4.6.
It outright beat Claude Sonnet 4.6.
And GLM 5.1 and Grok 4.2. Going from an 18 to a 52 in one generation, how does that mechanically happen in 12 months?
That is the core question everyone in Silicon Valley was asking on April 8th. You don't get a 34-point jump on a logarithmic difficulty scale just by letting the computers run a little longer.
Right.
It isn't just adding more horsepower to the old engine. It requires fundamentally re-architecting how the model processes logic.
Because if it were just scale, everyone with a big enough servo farm would be at a 52.
Precisely. It tells us that during that year of quiet, Meta wasn't just hoarding NVIDIA GPUs, although they certainly did do that.
We know they bought everything they could get their hands on.
Oh, yeah. But they were likely pioneering massive breakthroughs in synthetic data generation, finding ways to train the model on high-quality AI-generated reasoning paths rather than just, scraping the internet for human text.
Right, because we've run out of the internet to scrape.
Yeah, exactly. It also points to a highly advanced mixture of experts architecture, where the model essentially routes different types of queries to specialized subnetworks, drastically increasing its effective parameters without linearly increasing the compute cost.
Let's dive deep into that compute cost, actually, because this is where the artificial analysis report really shines.
It's the most important part.
It isn't just that Muse Spark is smart, it's how efficiently it achieves that intelligence. The report highlights that Muse Spark used only 58 million output tokens to run the entire intelligence index.
To contextualize that number, Gemini 3.1 Pro Preview used 57 million, so they are neck and neck there. Very close.
Okay.
But look at the other frontier models. GPT 5.4 on its extra high reasoning setting used 120 million tokens.
Wow.
And Claude Opus 4.6, running adaptive reasoning at maximum effort, chewed through 157 million tokens.
Let's translate this for you listening, because token efficiency sounds like deep technical jargon.
It does.
But it is effectively the new Moore's law for AI unit economics. Why does it matter if Muse Spark uses 58 million tokens instead of Claude's 157 million to reach a similar conclusion?
It comes down to the fundamental physics of data centers. Every single token an AI generates requires a massive matrix multiplication calculation.
And math requires power.
Yes, that calculation requires physical GPUs, which require massive amounts of electricity, which generate heat, which requires massive cooling systems.
So generating a token is a physical thermodynamic event, not just a line of code executing in the ether.
Exactly. When Claude Opus 4.6 needs 157 million tokens to think through a complex reasoning problem, it is consuming a vast amount of physical energy and occupying server bandwidth for a prolonged period.
Perfect.
If Muse Spark can reach a highly intelligent conclusion using only 58 million tokens, it means its internal reasoning pathways are exponentially more direct. It doesn't need to generate endless pages of internal scratchpad text to find the answer.
It's the difference between like a student who has to write out 10 pages of long division to find an answer versus a student who can do the calculus in their head in 3 steps.
That's a great way to put it. Both get the right answer, but one is vastly more efficient. And for a company like Meta, efficiency is everything.
Why specifically Meta? Because of the scale.
Because of their user base.
Yeah.
When you have 3 billion daily active users across Facebook, Instagram, and WhatsApp, unit economics dictate survival.
Oh, right. 3 billion people asking questions.
Exactly. If you deploy a highly intelligent model to billions of people, and it takes 150 million tokens to answer a query, you will literally melt your data centers and bankrupt the company on electricity costs alone.
So Muse Spark was engineered specifically to be economically viable at planetary scale.
Yes.
And it isn't just text either. The artificial analysis report notes that Muse Spark is the second most capable vision model they have benchmarked.
Which is huge.
It scored an 80.5% on MMMU Pro, trailing only Gemini 3.1 Pro. It is seeing and interpreting complex images and spatial data at a world-class level.
Which is non-negotiable for a platform where the primary modes of communication are photos and video reels.
Right. Instagram is entirely visual, but here's where it gets really interesting to me. The reasoning scores.
Let's look at them.
Artificial Analysis notes it scored 39.9% on HLE, which trails Gemini and GPT 5.4, but is still undeniably a frontier-level score. But then they highlight the CritPT score.
Oh, yes.
Muse Spark achieved the fifth highest score in CritPT at 11%, substantially beating out Gemini 3 Flash and Claude 4.6 Sonnet.
We should define CritPT for context. It is an evaluation focused entirely on highly difficult graduate-level physics research questions.
And this just stopped me in my tracks. I'm reading this thinking, why does Meta, a company that generates revenue by serving targeted advertisements between pictures of golden retrievers and vacation photos, dedicate the immense, eye-watering compute required to master fluid dynamics and quantum mechanics?
It seems bizarre on the surface.
It seems completely unnecessary.
This raises an important question about how generalized artificial intelligence actually forms. It seems completely counterintuitive that Instagram needs a physicist AI in its backend. But the goal isn't to solve physics.
Then what is it?
The goal is to forge a generalized reasoning engine.
So the physics is just like the whetstone they were using to sharpen the blade.
Precisely. Physics is fundamentally about understanding the immutable laws of reality, predicting outcomes based on highly complex variables, and executing flawless logical deduction.
Okay, I'm following.
If an AI can accurately reason through a multi-step quantum mechanics problem without hallucinating, it proves that the underlying neural network has developed a robust, structurally found internal model of logic.
I see. So if it can maintain the logical coherence required to map the trajectory of a particle through a magnetic field over 20 steps of reasoning.
It can certainly figure out the absolute optimal algorithmic sequence to show a user to maximize engagement.
Oh, wow.
Or figure out how to optimally route data through a massive server farm, or write perfectly efficient code for their internal engineering teams. You're training the AI how to think rigorously.
The subject matter doesn't matter. It's the process of thinking.
Exactly. The fact that Muse Spark scores an 11% on an incredibly punishing physics benchmark proves that Meta Superintelligence Labs hasn't just built a good conversational chatbot. They have built a profound reasoning engine capable of sustained logical thought.
But there is a massive catch to all of this.
There is.
And honestly, when I hit this part of the artificial analysis report, it felt like a betrayal of everything Meta had been preaching for the last few years. Despite these incredible specs, despite closing the gap to the frontier, Meta has executed a monumental strategic pivot.
The biggest news of the day, really.
Muse Spark is not open weights.
It is not. This is perhaps the most consequential business news of the entire release. It is Meta's first frontier-class model that is entirely proprietary and closed.
I have to push back on this because it feels incredibly cynical. Mark Zuckerberg spent the last 3 years loudly positioning himself and Meta as the ultimate champions of open-source AI.
He was the poster child for it.
He planted a flag in the ground saying that open access is the only safe and innovative way forward. They gave away the Llama series to researchers, startups, and developers worldwide, forcing competitors to justify their paid models.
They commoditized the lower tiers.
Right. So isn't locking down Muse Spark and keeping it proprietary a total 180-degree reversal of their core corporate philosophy?
It is a massive shift, and it forces us to analyze the real moat in the AI industry. Why abandon the open source mantle right at the very moment you achieve a breakthrough to the absolute frontier tier?
Exactly. What is your read on this? Was open source just a marketing gimmick while they were the underdog? And now that they are tied for first, it's all about the money.
The cynical view holds weight, but the economic reality is likely the primary driver here.
Meaning the cost.
Yes. Consider the sheer capital expenditure required to train a model that scores a 52 on the intelligence index. The cost of the NVIDIA clusters, the specialized tooling infrastructure, the energy procurement contracts.
It's billions and billions of dollars.
And we're talking about an investment that likely dwarfs the entire GDP of small nations. Giving away a model of that caliber for free, allowing your direct competitors to download it, fine-tune it, and use it against you, it becomes financially indefensible to your shareholders at a certain scale.
So Llama 3 and Llama 4 were cheap enough to give away as loss leaders to commoditize the models below the frontier, thereby hurting Google and OpenAI. But Muse Spark is just too expensive a weapon to hand over to the enemy.
That is the exact economic calculus. Secondly, there's the regulatory capture angle, wrapped in, legitimate safety concerns.
How so?
When a model jumps from an 18 to a 52, its capabilities in generating zero-day exploits, writing malicious code, or analyzing sensitive data scale up exponentially.
Because it's so much smarter.
Releasing open weights means you surrender the ability to install post-training safety guardrails. Once the weights are downloaded, it is out of your control.
True, someone could strip the safety features right out.
Exactly. By keeping it proprietary, Meta can tell regulators, look, we have this immensely powerful entity, but don't worry, we are keeping it safely locked in our basement. We have full control.
It's the ultimate bait and switch. Build goodwill and developer dependency with open source while you are catching up, and the moment you pull ahead, lock the doors.
And artificial analysis notes that there isn't even a public API available yet, though Meta says it's coming.
Right, they are keeping it tight. Instead, Meta is immediately integrating Muse Spark directly into their first-party products.
Meta AI, Facebook, Instagram, and Threads.
And that is the ultimate key for you, the listener. You won't be downloading Muse Spark's underlying code to build your own startup or run on your local machine.
No, you won't.
You will be experiencing this immense 52-score intelligence carefully curated through the lens of your Instagram feed.
Meta is keeping the keys to the castle so they can monetize the interaction directly within their own walled ecosystem, driving up ad retention and user engagement.
But as incredible as Muse Spark is, and as much as it terrified the market into sending Meta's stock up 6.5%,
there is a caveat.
the artificial analysis report makes it clear that it is not a flawless, omnipotent machine. Every giant has an Achilles heel, and Muse Spark's is very specific.
Yes, the report highlights a critical area where Muse Spark lags significantly behind its peers, and that is agentic performance.
Let's break this down for everyone, because despite having sky-high intelligence and reasoning scores, when it comes down to actually doing things autonomously, it struggles.
It does.
The benchmark artificial analysis uses here is GDP-Val-A, which is an evaluation focused on real-world work tasks. Muse Spark scored a 1427.
To put that in context, Claude Sonnet 4.6 scored a 1648, and GPT 5.4 scored a 1676.
That's a big gap.
So Muse Spark is not just slightly behind. It is structurally trailing in this specific domain. It also trails Claude and GPT significantly on Terminal Bench Hard, which tests an AI's ability to operate within a command line interface.
So how can an AI be an absolute genius at reasoning through quantum physics but terrible at real-world work tasks? It feels like a paradox.
It highlights the fundamental difference between an AI that can think and an AI that can do.
Okay, unpack that.
Reasoning evaluates an AI's ability to analyze static information, draw logical conclusions, and generate text-based answers.
Sitting in a room and thinking.
Yes. Agentic performance evaluates an AI's ability to take multi-step actions in dynamic, unpredictable environments to achieve an open-ended goal.
It's like having a brilliant philosopher in the passenger seat of your car.
I love this analogy.
Right. This philosopher can explain the thermodynamics of the internal combustion engine perfectly. They understand the physics of tire friction. But if you get a flat tire on the highway, they have absolutely no idea how to operate a jack, remove the lug nuts, or navigate through traffic to find a mechanic. They can think profoundly about the world, but they lack the agency to act upon it.
That is exactly the distinction. An agentic AI can be given a high-level command like, log into my CRM, find the 5 clients with the lowest engagement this quarter, draft personalized email outreach based on their previous purchases, and queue them up in my outbox.
Which is a ton of discrete steps.
Executing that requires using external tools, interacting with software interfaces, recognizing when an error occurs, self-correcting, and executing a workflow. Muse Spark, right now, lacks that level of execution capability compared to GPT 5.4 or Claude Opus.
But if we look at Meta's broader corporate strategy, the walled garden we just talked about, does poor agentic performance actually matter to them?
That is the crucial insight of this entire release.
Tell me.
A model with immense reasoning capability but low agentic performance makes perfect sense for an intelligence designed to live exclusively inside social media applications.
Because I don't need my Instagram app to log into my CRM and send emails.
Exactly. When you interact with Meta AI on WhatsApp, you are asking it to generate a recipe, summarize an article, create a synthetic image, or answer a factual question.
You want an answer, not an action.
You want it to be smart, token efficient, and instantaneous. You don't need it to autonomously execute complex enterprise workflows in the terminal of a server.
That makes total sense. Meta didn't build an enterprise agent. They built the ultimate consumer intelligence optimized for content generation and information retrieval.
Which perfectly serves their business model.
So what does this all mean? When we step back and look at the totality of the data we've analyzed today, from Morningstar, Trading Key, the Motley Fool, and artificial analysis, April 8th, 2026 was fundamentally defined by two massive, world-altering unblockings.
In the physical world, the unblocking of the Strait of Hormuz, the lifting of a geopolitical siege that allowed millions of barrels of oil to flow, crashing energy prices, easing global inflation models, and reviving hopes for a soft landing and lower interest rates.
Sending the broader market soaring.
Yes.
And in the digital world, Meta unblocking its own AI stagnation. After a year of silence, they dropped Muse Spark, a proprietary, highly efficient frontier-class model that leaped to a 52 on the intelligence index, proving they have the compute and the architecture to challenge the absolute top tier.
Sending the tech-heavy Nasdaq flying.
It is a profound reminder of how deeply intertwined the macro and the micro truly are. The physical constraints of geography and the digital constraints of compute power are the twin rails our economy runs on.
They dictate everything.
And that is why this matters to you. Whether it is the price of a gallon of gas influenced by the movement of ships through Middle Eastern streets, or the algorithms driving the content on your phone influenced by neural networks mastering advanced physics to keep you engaged.
These massive global forces are interacting with your daily life every single minute.
We saw today how a geopolitical conflict directly impacts global markets and supply chains. But consider this.
Here's the real thought experiment.
With Meta integrating a highly intelligent but now fully proprietary and closed AI like Muse Spark directly into the social media feeds of billions of people, how will this powerful new intelligence shape the information you consume about the next global conflict?
That is a chilling and fascinating thought to leave on. The AI that curates our reality is now smarter, faster, and completely locked behind closed doors.
Thank you so much for joining us on this deep dive into these sources. Keep questioning the physical world, keep questioning the digital world, and we will catch you next time.